March 14, 2026. Nobody explained what really happened. Iran announced tankers passing through Hormuz must settle cargo in yuan, not dollars. Yuan. At the choke point carrying 20% of global oil, where the petrodollar has ruled for 50 years, a currency was just weaponized. I have studied monetary systems for 40 years, and I can tell you this is not a military story. This is a monetary system story, and it will define the rest of your financial life. But the shocking part is not Iran's move. The shocking part is what Saudi Arabia quietly did and nobody noticed. I will give you that detail at minute 8. But first you need to understand how this system was built, because you cannot understand what is being lost until you see what could be gained. In 1971, Nixon ended the gold standard. The dollar was no longer backed by gold, only by America's word. The problem was obvious. Why would the world hold dollars? The answer came in 1974. Kissinger cut a quiet deal with Saudi Arabia. America provides military protection, the Saudis price all oil in dollars, and recycle surplus petrodollars back into U.S. Treasury bonds. OPEC followed. The petrodollar system was born. The single critical assumption underlying this system was this: oil will always be priced and settled in dollars. On March 14, 2026, Iran targeted that assumption militarily and financially simultaneously. And something I have never seen before happened. Iran is using physical control to force a currency substitution. Let me explain the mechanism step by step because most people are not seeing this. When Hormuz closed, war risk insurance hit 7.5% according to Lloyd's of London, 150 times normal. Commercial operators found transit economically impossible. Then Iran made its announcement: tankers can pass, but cargo must be settled in yuan. Think about what this means mechanically. Every barrel settled in yuan means one less reason for countries to hold dollar reserves, one less purchase of U.S. Treasury bonds, one less unit of the structural dollar demand the petrodollar system creates. And this moment is different from every previous petrodollar challenge because this is not a theoretical proposal. This is military force enforcing a currency demand. Bloomberg reported on March 15th an Iranian supertanker pushed through the strait bound for China. Chinese tankers were given passage. Indian tankers negotiated access through diplomatic channels. Turkish tankers were seen transiting. And the vessels denied passage? Those linked to the United States, Israel, and Western allies. The Strait of Hormuz has become a de facto yuan settlement zone. And Saudi Arabia, the country whose 1974 agreement with Kissinger created the petrodollar system, is watching its airports bombed and oil fields struck as a direct consequence of a war launched by its American protector. Here is where things get important, and this is the part nobody is fully explaining. On March 5, 2026, the Financial Times reported that 3 of the 4 largest Gulf economies, Saudi Arabia, the UAE, Kuwait, and Qatar, had quietly begun reviewing whether they could invoke force majeure clauses in existing contracts with the United States and scale back hundreds of billions in future investment commitments. Stop for a second and think about what that sentence means. The Gulf states that built the petrodollar system, that recycled trillions of dollars into American debt, that kept the dollar as the world's reserve currency for 50 years, are reviewing whether to back away from their commitments to the United States. Not because they want to, because the war launched by their protector is bombing their airports and striking their oil fields. The petrodollar arrangement was never a formal treaty. It rested on mutual interest and the absence of any credible alternative. For 50 years, both conditions held. Both conditions are now being tested simultaneously. And here is the detail I find most significant of all. Saudi Arabia effectively ended its exclusive commitment to dollar pricing in June 2024, before this war began. It built a $7 billion currency swap with China and joined the mBridge payment platform. In March 2026 alone, mBridge, the digital payment system that allows central banks to settle trade directly in their own currencies, bypassing the U.S. banking system and the SWIFT network entirely, handled over $55 billion in trade. The infrastructure for a post-petrodollar world was not built in response to this war. It was built in anticipation of a moment like this. And that moment has now arrived. Now, I want to be very precise about what this means and what it does not mean, because I think the most important thing I can give you is an accurate map, not a dramatic one. Is the dollar going to collapse? No, let me say that clearly. That the yuan is not ready to replace the dollar as the world's reserve currency. China maintains capital controls. Its financial markets are not as open, liquid, or trusted as American ones. The legal protections and institutional depth of dollar-based markets have no equivalent in yuan-based systems. Many countries unhappy with US dollar dominance are not eager to exchange one monetary dependency for another. What is happening is something more subtle and over a long time horizon, more consequential: acceleration. The dollar's share of global foreign exchange reserves has been declining gradually for years, from around 71% in 2000 to approximately 58% today. That erosion happened slowly without a single dramatic catalyst. What the 2026 Iran war has done is provide multiple catalysts simultaneously. Iran demanding yuan at Hormuz does not create a new direction in global finance. It accelerates an existing one. Saudi Arabia reviewing its petrodollar commitments does not mean Riyadh will price oil in yuan tomorrow. It means the 50-year assumption underlying the system that America would protect the Gulf states when they needed protection has been visibly, publicly, and dramatically tested. And the test results are not encouraging for the dollar. Every energy importing nation is now recalculating the currency risk embedded in its supply chain geography. Every central bank watching this unfold is asking the question Ray Dalio has been raising for years. If the United States can weaponize the dollar against Russia, against Iran, against Venezuela, what happens to our dollar reserves if we ever find ourselves on the wrong side of American foreign policy? That question does not go away when the Iran war ends. It gets louder. Let me walk you through what I think the two scenarios look like from here, because this is the most useful thing I can offer you. Scenario 1. The war ends relatively quickly, the strait reopens, oil flows resume in dollars. In this scenario, the petrodollar system survives, but it survives damaged. Saudi Arabia's airport bombing is not forgotten. The yuan settlement experiment at Hormuz demonstrated it is technically possible to price oil in a non-dollar currency through a major choke point. The Enbridge infrastructure remains operational. Central banks already quietly reducing dollar reserves accelerate that reduction. The dollar's share of global reserves continues its long decline, moving faster than it would have without this war. Gold continues to benefit as the asset that carries no counterparty risk and no government can freeze. Scenario 2. The war extends, the Hormuz closure becomes semi-permanent, and the yuan settlement precedent becomes normalized across Asian energy trade. In this scenario, which I consider less probable but not negligible, the structural demand for dollars begins to erode measurably. Countries that need Gulf oil begin building yuan reserves to access it. Treasury bond demand from petrodollar recycling declines. The United States, which relies on that demand to finance its $36.2 trillion debt at manageable interest rates, faces upward pressure on borrowing costs at precisely the moment when its fiscal position is already the most stretched in peacetime history. In scenario 2, the consequences for every dollar-denominated asset, stocks, bonds, real estate, cash savings are significant. And the assets that benefit are the ones I have watched central banks accumulate for 3 consecutive years at double the historical rate: gold, real assets, and non-dollar reserve currencies. Here is what I think you should understand about your own financial position right now. The most important insight I can offer is this. The dollar losing reserve currency status is not a binary event that happens overnight. It is a process, one that has already been underway for years, one that this war has dramatically accelerated, and one that will continue regardless of how the immediate military conflict resolves. In that context, the question is not whether to abandon dollar assets entirely. The question is whether your portfolio is positioned to reflect the reality that the dollar's share of the global financial system is declining, and that the assets that benefit from that decline deserve a larger allocation than most retail investors currently have. Gold is the most obvious beneficiary. Not because gold goes up when there is a war, as the recent crash demonstrated that is not always true in the short term, but because gold is the only monetary asset that carries no counterparty risk, no issuer whose fiscal decisions can debase it, and no government that can freeze it through a sanctions order. Those properties are worth more in a world where the weaponization of the dollar has demonstrated that dollar assets can be confiscated at a sovereign level. Central banks understand this. They have been buying gold at double the historical average for 3 consecutive years. They were not doing this because of the Iran war. They were doing this in anticipation of a world where the dollar's exorbitant privilege was being eroded. The war has simply confirmed their thesis faster than any of them anticipated. Let me close with the big picture. The petrodollar system was built in 1974 on 3 pillars: stable Gulf energy production, dollar-denominated oil trade, and American military protection of the Gulf. All 3 pillars are now under simultaneous stress for the first time in 50 years. Iran demanding yuan at Hormuz is not the end of the petrodollar, but it is the moment historians will point to when they describe when the system's vulnerability became undeniable. Not theoretical, not gradual, undeniable. The most dangerous thing an investor can do right now is look at this moment and conclude that because the dollar has not collapsed yet, it will not. Reserve currency transitions do not announce themselves with a single day of crisis. They accumulate through a series of moments, each one individually survivable, collectively decisive, until the system has shifted so far that the shift becomes self-reinforcing. I have studied the decline of the Dutch guilder, the British pound, and every other reserve currency in modern history. In every case, the moment the transition became unstoppable looked at the time like just another crisis that would eventually pass. The Iran war may pass. The yuan settlement precedent at Hormuz will not.